As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Today we have with us the senior management represented by Mr. Venu Nair, Customer Care Associate, Managing Director and Chief Executive Officer, Mr. Karunakaran Mohan Sundaram, Customer Care Associate, Chief Financial Officer, Mr. Jaiprakash Maheshwari, Customer Care Associate, Vice President Finance and Accounts. We will begin the call with the opening remarks from the management, after which we will have the forum open for an interactive Q&A session. I must remind you that the decision in today's earnings call may include certain forward-looking statements and must be viewed, therefore, in conjunction with the risk that the company faces. Please restrict your questions to the quarter and yearly performance and to strategic questions only. Housekeeping questions can be dealt with separately with the IR team. I will now request Mr. Venu Nair for the opening remarks. Over to you, sir.
Thank you, Rutuja, and good morning, friends. Thanks for joining us today to discuss the Shoppers Stop financial results for the third quarter of FY23. As Rutuja mentioned, along with me I have Karuna, our CFO, and Jaiprakash, our FP and A lead. Our Q3 and the year-to-date results, investor deck, as well as the press release have all now been shared on our website, BSE and NSE. I'm confident you have gone through this. For the last 8 quarters, we have been growing consistently. For this quarter too, we have achieved our highest quarterly sales, EBITDA and PBT. Our success in the last 8 quarters and the continuous improvement therein is the outcome of our well thought out strategy and of the judicious capital allocation that we have been doing. Let me now get into the details of our Q3 performance and the way ahead. The strong momentum that started at the beginning of the year has been continuing, even though we witnessed a little bit of moderation on that immediately after Diwali. Fortunately, it did not last long. We had robust sales in the quarter, growing at 20%. Our gross margin improved by 20 basis points, our EBITDA by 27% and PBT by 44%. We had our highest ever EBITDA of 128 crores during this quarter. Of course, this did include a one-time income of 17 crores, which I will talk about a little later. Even excluding that, it was our highest ever quarterly profit on EBITDA and PBT. The run-up to Diwali was strong, as I said, initially in the east up to Pujo and then for the rest of the country. Post-Diwali, we did have a couple of weeks of muted sales. Our focus on beauty through Singles Day and Black Friday helped to bring customers back to our stores and online. Subsequent to that, December sales were led by winter wear, wherein we had invested disproportionately this year. And this again helped to bring customers back into our stores. On some of our other KPIs, our average transaction value grew by 10% versus last year due to the mix of our customers purchasing higher value-added products. Our average selling price grew by 10%. Our items per basket was flat and our cash memo count increased by 11% last year. And these significant improvement in KPIs indicate the strong undercurrent of the business and our ability to deliver results now for 9 quarters consecutively. Our average bill value has now been increasing for 11 quarters consecutively. And this is a clear indication of the fact that our customers are blessing us with more business. Let me now share some of the details on operational costs. On a like-for-like basis, our costs remain flat. Excluding lease rental escalations, our investment in e-com, refurbishing the store, etc., was an investment of 25 crores. We do believe these investments are critical for the future and we will continue to invest. Last year, we did receive some rebates on lease rentals due to COVID, which helped us to lower our occupancy cost. And overall, the costs have gone up by 10%. It is purely due to the new stores and investment as said above. With the strong sales and the tight control on costs, we reported an EBITDA of 128 crores. In non-GAAP, a growth of 27% and rupees 24 crores as per GAAP financials. Last time, we had briefly touched upon our plans to strengthen our beauty business. I would like to give more details on this now. We have now got into the distribution of beauty brands with exclusive rights for India. Our beauty strategy is to be the best beauty destination with leading engagement combined with great customer experience. In addition to this, we expect our company to become the priority retailer for all beauty brands internationally and in India, make the stores more interactive, educative, and engaging, continue to make our website stronger with our own brands and distribution brands, and strengthen the SS Beauty brand across both a standalone and within our own Shoppers Stop stores. Our long-term objective is to distribute international luxury, bridge to luxury and premium brands in India, positioning these brands as experts within their categories, capitalizing on their history, strengths, and expertise. This is to enable our brands and brand partners to create a strong distribution vertical across fragrance, skincare, and makeup categories. We will have exclusive launches and plan to capitalize on this. We are starting off this vertical launching 8 brands from the L'Oreal International Division, Clarins, and Earthy. We expect this division to contribute more than 500 crores in the next couple of years and add a significant profit to the bottom line. This distribution business will be through our 100% subsidiary Global SS Beauty. Our capex investments in new stores and refurbishments for the quarter was at 21 crores. I'm extremely happy to say that we opened 6 department stores and 5 beauty stores during the quarter. Needless to say, our capex has been funded through internal resources. Not only that, but our internal accrual is also sufficient to fund our loan repayments as on date this year. During the quarter, the working capital increased by 85 crores, primarily in our private brands and beauty. Both these verticals are recording healthy growth, and we believe we need to invest in these verticals, particularly during the festive season such as Diwali and Pujo, and also the end of season. All of these have been funded by internal accruals. Having said that, we are monitoring the inventory levels very closely, and you will observe a reduction in the absolute inventory numbers by the end of Q4. Last year, we had provided around 25 crores as interest in the previous years, particularly during COVID. However, the relevant sections in statutes have now been repealed, and we have had a one-time benefit of reversing this provision of up to rupees 20 crores. Of the 20 crores, we have included rupees 17 crores as other income and rupees 3 crores reduced from the interest expense. As always, as a compliance adhering company, we had provided interest on a conservative basis month on month, and as these provisions are no longer required, we have now reversed them. We have obtained the experts' advice on the same and implemented the same accordingly. From operations, I will now move to the performance of our strategic pillars. As always, I'll focus on each of our strategic pillars. First Citizen. is our first strategic pillar, and a few notable features on our First Citizen program. We have always believed our customers are our success. The retail landscape is fast changing. Today's consumers seek personalization and demand experiences going beyond the typical shopping experiences. Through experiential retail, we can give our customers unique and innovative experiences, both online and inline. Our ability to engage with our customers, and specifically our First Citizen customers, based on the information that they share with us and we have of them, gives us a unique advantage in the market. Of the total offline sales, our loyalty members contributed to 77% and our online sales contributed to 38%. Our new enrollments have increased by over 2 lakh members compared to the previous quarter. Overall, for the year, we have now added over 7 lakh new members. Apart from the active members, we also focused on bringing back customers who have not come to us for over a year. I'm extremely happy to say that we converted 1,40,000 members from inactive to active. This indicates the strong loyalty to our membership program and speaks volumes of the ability for us to engage with our loyalty members and make shopping a delight for them. Not only are we focusing on bringing back customers who have not shopped with us for over a year, we are focusing on ensuring that they come back a second time after we bring them back, ensuring that it is a sustainable return to our business. We started our HDFC co-branded loyalty card in April this year, and I'm happy to say that we have added more than 30,000 co-branded members in the last 2 months. We also added a significant number of new Black Card loyalty members during the quarter. For our Black Card loyalty members, and this is our unique annual subscription program, as you will remember from the previous calls, and we continue to focus on these customers by offering them experiences unique and different to what they would normally get. During the quarter, we had a special showing of Mughal-e-Azam for our Black Card First Citizens in Mumbai, had a golfing Sunday, and in the East, we had specific Pujo-related showing for them at the West End. The average spend of this Black Card customer is as much as 4 times of our normal members, and we will continue to focus on this segment. On private brands, which is our second strategic pillar, the private brands business grew by 23%. We achieved rupees 203 crores of sales for the quarter, an important milestone for our private brands. This is the highest quarterly sales that we have achieved in the history of the company. Year to date, we have grown our private brands business by 84%, and sequentially, quarter on quarter, our private brand sales have consistently grown. As a proportion of our total business, it now contributes to 20% of our total apparel business and 14% of our total business. Within the digital channels, our private brands contribution has increased to 16.5%. During the quarter, we had invested in Kashish, which is our Indian wear brand for women's, and on Bandeya, which is a menswear brand for men, which is a menswear brand. Both of these had very strong growth. Our focus on women's apparel has yielded very, very satisfactory results. In fact, in Indian wear, our private brands now contribute to almost 50% of our total business. Also worth mentioning that our own brand stock which is the everyday workwear brand that we have, is the largest brand that we now have in apparels across our own stores and online. Moving on to the third strategic pillar of beauty. Our beauty business grew by 18% with an all-time high mix of 16.2% to our total sales. This has been one of our best quarters for beauty in the history of Shoppers Stop. Engagement with customers is a key part of the beauty buying process. We did 112,000 makeups during the quarter, which led to strong engagement and higher sales. It is worth mentioning that this 112,000 is against an original plan to do 100,000 makeovers in the full year. Compared to that target of 100,000 makeovers for the full year, we actually did more than that just in one quarter. And we will now end up doing over 4 lakh makeovers in the full year, which illustrates the great traction that we have had with our beauty customers and gives us a strong platform to bring customers back into the stores. As you will understand, the whole engagement that comes in with makeovers gives us a unique opportunity as a retailer in this business. November is an important month in beauty. We had Black Friday and Singles Day with exciting offers on our beauty products and campaigns endorsed by Malaika. We recorded our highest ever sales during this period as well. We opened 5 beauty stores during this quarter and made considerable progress in our exclusive beauty website. The ssbeauty.in website as well as the SS Beauty app is expected to go live in the first week of March 23. Currently, it is in the testing beta phase within a closed group. Which brings me on to the next strategic pillar, which is omni-channel. And as I've explained before, we've had a great healthy growth in our offline business, and during the fiscal, our customers have had the option of visiting our website, coming to our stores and buying the same. With a strong base in FY22, our overall sales through the digital channel remained flat. But we do know that all customer journeys start, or the majority of the customer journeys start online and then happen offline. And that's the reflection of the fact that we have got strong, healthy sales. We continue to offer personalized suggestions to potential buyers based on their past search history, and we are gaining immensely from this. To make a truly omni-channel system perfect, it is essential that there is strong integration between our stores, warehouses, and having real-time inventory. And I'm extremely proud to say that we are the first large retail business to be able to do this, offering products to our customers across the entire ecosystem that we have of the 250 plus stores and shopperstop.com on a real-time basis. Today, over 70% of what we ship to our customers is from our stores. Specifically on the numbers and our investments, we continue to invest into digital, and we invested in performance marketing, tech upgrades, and more importantly, the new website on ssbeauty.in. Finally, moving on to expansion, I'm glad to say that we opened 6 new department stores and 5 new beauty stores during the quarter. Of the above, 2 are in Tier 1 cities and 2 in Tier 2 cities where we continue to focus. As on date, during this financial year, we have now opened 9 department stores and 11 beauty doors. Apart from renovating 9 large stores, we have incurred a capex of 101 crores, and which includes technology, and 6 crores as opex for renovating the stores. These are completely funded by our internal accrual, which signifies the strength of our balance sheet. In conclusion, I would say that we have been able to sustain the strong momentum on sales, both organically and inorganically. Our success of the last 8 quarters and the continuous improvement therein is an outcome of the well-thought-out strategy that we have in place and the judicious capital allocation that we have been doing. Retail has changed dramatically over the last couple of years, and we have adapted to that change, transforming ourselves into an omni-channel retailer, focusing on engaging with our customers and offering them a great experience whenever and however they interact with us. Our pristine balance sheet gives us the ability to invest in our growth areas. That's beauty, expansion, digital, data analytics, and private brands. With the sales growth we are planning for the next 3 years, we should be able to deliver significant cash. Our framework approach is customer experiential focus, engagement-led, and community building, while remaining conscious of capital allocation. This framework approach has guided us well in the last 2 years, and we believe this framework will serve us well in the coming quarters. I'm fairly confident our total sales growth should be able to maintain the mid-teen growth post-opening of the new stores and the pipeline that we have. We have just begun our journey on distribution of beauty, and we should be the priority retailers for all international brands, particularly in the premium and lifestyle spaces. We will continue to deliver on our strategic pillars, and most importantly, our engagement with our customer will make Shoppers Stop the ultimate destination for their business and for their buying. Thanks for listening, and I'll now request the moderator to open the floor for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Nihal Maheshwari from Nuvama. Please go ahead.
Yes, thank you so much and good morning to the management. So 3 questions from my side. First is just required a couple of data points. One is, could you share the like-to-like growth versus pre-COVID and the walk-ins excluding the online visits?
Okay, do you want to go through all 3 and then answer?
Sure, I'll just mention the other 2 also. The second one was that when you're speaking of this 500 crores for the B2B distribution business, could you give a sense of, what are the kind of counters we are targeting to reach, the roadmap for the same, and potentially there would be initial cost if you could quantify the same? And the last question would be, are we contemplating any other format in the value segment? There have been certain press articles on it, and if you could just give some more clarity.
Yeah, okay. So on the first one, in terms of the walk-in growth, the year-to-date number, the Q3 numbers, specifically we had an overall growth of 16% in total and a like-for-like growth of 1%.
Sure. The like-to-like growth was 1%, if I heard right.
Pre-COVID, yeah. Okay. And that's over pre-COVID.
Okay, that's it. And on the walk-ins, just for the offline, the store business?
On the offline business alone, over 3 years, it was largely flat at a total level and -7 on a like-for-like basis.
Is it possible to get the absolute number? We've given the customer entry of 39, which I think includes online. I was just looking at the offline entry specifically.
Yeah, just 1 second.
Nihal, can I just message you separately on that? Because we now track both online and offline together, I will message you separately what will be the offline visits.
Sure. I'll wait for that. Thanks.
Okay. Now, just coming back to your question on beauty, You did ask something. You said the distribution business. You asked something about the cost. We could not hear fully.
Yes. So what I was referring to, you gave a target of 500 crores from this business in the next couple of years. Is it possible to give a sense of, what are the kind of doors we plan to reach for the distribution business and the cost that will also entail, given it's a new business that we are setting up totally organically?
Yeah. See, in terms of cost, this should be largely break even from year 2 onwards. Even year 1, it should be a very, very minimal loss. In terms of the doors, what we are approaching is lifestyle, Arcos and Sephora and other beauty companies, Nihal.
Just one thing, there would be no targeting on GT. I know these brands are premium, but just to be sure of the fact that there won't be a focus on general trade or trying to reach these counters. It will mainly be the premium beauty retailers.
Absolutely. Our focus will be on the premium organized retailers.
That makes it clear. Sure.
Just coming back to your question on walk-ins, offline walk-ins grew by 14%.
Sure. Thank you.
Yeah.
And the last bit on the value fashion.
That's, while it has something which has appeared in the press in the past, it's not, and it is a very attractive segment and a segment that we continue to look at. At this point, we won't have anything concrete to be able to share, but as and when we crystallize our plans on that, we will come back on that.
Absolutely. Thank you so much, sir. I wish you all the best. I'll come back to the queue for my further questions.
Thank you.
Thank you. The next question is from the line of Bharat Chodha from ICICI Securities Limited. Please go ahead.
Yeah, hi. So basically, I just wanted to understand about this gross margins in the beauty business like that we are targeting.
So, Bharat, are you referring to the gross margin in the distribution business?
Yes, distribution, yeah.
Okay, it will be more or less same in the range what we are doing right now, between 30 to 35%. That would be the range we are targeting the gross margins for our distribution business also.
Okay. And would we be spending anything on this, or the brands would be spending for the brand visibility, or how it is in this ideally? How, and anything that we are paying to them specifically, something like a royalty payment? How this model works, sir?
So it does vary from brand to brand in terms of what the arrangements would be. But broadly, the investment into marketing and building the brand tends to be done by the brand itself.
Okay. Thanks for answering the question, sir. Thank you so much.
Thank you. The next question is from the line of Percy Panthaki from IIFL Securities. Please go ahead.
Just continuing from the previous question on the distribution business, gross margin of 30-35%, that is actually quite unheard of. I mean, Nykaa has a similar B2B distribution business, and they mentioned that they would be targeting a 10 to 12% gross margin and a 5% kind of a EBITDA margin. So just wanted to understand, when there are two people in the value chain sharing the overall margins, how is it that the margins are so high in this business?
I cannot comment on what the others are doing. It is on the wholesale price that these margins are talked about, and it's probably the base which might be different. Happy to discuss it separately and get into more detail to explain that.
Sure, understood. And also, just to confirm, this 500 crore target is for FY26?
Across the next 2 years, so by FY25, we should be getting close to that number.
Right. And also, just like you shared some idea on gross margin, once you achieve that scale of 500 crore, what kind of EBITDA margin would you target on this business?
Prati, as Venu said, this will be in a separate subsidiary called Global SS Beauty Limited. So EBITDA margins will be slightly higher than what our Shoppers Stop margins are. Though the initial years it will be there will be a break-even or a marginal loss, but in year 3 and year 4 it will be more or less in line with Shoppers Stop.
Understood. And how many brands have you tied up with for this distribution business?
We have currently tied up with over 12 brands, and this is obviously a business that we will continue to grow, and we will be adding more brands as we go forward.
Right, sir. And my last question is on the physical retailing part, your Shoppers Stop department stores. On a per square feet basis, this quarter, more or less, you are in line with the similar quarter pre-COVID. So just wanted to understand now, in light of your store expansion targets, do we see this sales per store on an average being flat from here? Because even if you do see a same store sales growth, the new stores opening up at below system average will pull down the average sales per square feet. So just your thoughts on this topic, sir.
I think it's a fair assessment, and in the short term, I reckon we would see a flattish sales per square foot. However, as we get into year 2 and year 3 from now, because of the overall percentage of new stores will start to shrink from the total mix, we would expect the numbers to continue to grow. I mean, the sales per square foot to start growing. Also, worth pointing out that a number of the new stores that we have now opened and are opening are smaller, which takes care of the productivity. So that the aim is we do start off with a strong sales per square foot in the new stores as well.
Right, sir. That's all from me. Thanks and all the best.
Thank you. The next question is from the line of Priyanka Trivedi from Antique Stock Broking. Please go ahead.
Yeah, hi. Thank you for the opportunity. My first question is on what would be the square foot figure?
I'm sorry.
Priyanka, your voice is not clear, Priyanka. Can you come closer to the mic, or it's very, very difficult to hear you.
Yeah, am I audible now?
Actually, Priyanka, your voice is breaking. Maybe you can shift to a better connectivity.
Now is it audible?
Yes.
Yeah.
Now is it better? Yeah. So my first question would be on what would be the square footage addition in the 9 months that have gone by, and if you could give the breakup between the department stores and the beauty stores, and the capex breakup also between these two.
So we added 9 department stores, which total to 308,000 square feet on a chargeable basis, or on a carpet area it was 237,000 square feet. And that's on that's the department store. And on beauty specifically, it was it's 11 stores that we added in total. So that would be circa around 15,000 square feet that we would have added.
Okay. And in terms of the capex, what would be the split, if that's possible?
So you're talking about the cash spent, Priyanka?
Yes.
Yeah, close to 100 crores in the first 9 months.
Okay. Got it. Okay. And my second question would be on if you could give us a sense on the contribution of the women's wear to our overall basket, and the split between the western wear and the ethnic wear of that.
Broadly within women's wear, western women's wear contributes to, the two put together contribute to 21% of our total business, with western women's wear being at around 21% and Indian wear being at 7%.
Oh, got it. That's it from my side. Thank you.
Thank you. The next question is from the line of Kaustubh Pawaskar from Sharekhan by BNP Paribas. Please go ahead.
Yeah. Good morning, sir. Thanks for giving me the opportunity. So my question is on demand front. As you mentioned that festive was good, but post-festive there was some moderation in demand. And for our case, I guess beauty was the one which helped us to mitigate, the pressure to some extent. So just want to understand from demand per se, what do you expect, how much time it will take, for things to, rebound, because again, there is a strong wedding season which is coming up. So in that context, can you provide some brief?
If we take our current trends, the kind of momentum that we had in December has continued into January. February is a strong wedding month, and hence we expect that to move up a bit more. But overall, if we look at the fundamentals, especially in the segment that we operate in, which is in the premium lifestyle space, it has been quite robust, and that's what we expect to continue.
Thank you. And what was the contribution of the online omni-channel business this quarter, and what was the growth on YOY basis, if you could give that number?
On a year-on-year basis, it was flat, and the contribution to the overall business from our digital channels was at 4.4%. Now, I must underline this with what we have been saying now for a few quarters. As an omni-channel business, what gets registered or where the final purchase is happening digitally is not just the only way we should be looking at it, because especially given that we operate in the premium space and the ASPs are high, for a number of products, customers would start the journey digitally but finish offline, and hence a lot of the business that we generate offline does start online, and that's the way it should be looked at. And that's also the reason we have stopped separating it out as online and offline. Being a true omni-channel retailer, the right way to do it is to look at it together.
Right, sir. And one last one on the capex. So how many stores you are planning to add over the next 2 years, and what could be the capex for the same, and whether we will be comfortable doing it through internal accruals over the next 2 years?
So we have budgeted to do between 12 to 15 stores every year, which we will do. This year we've opened 9. We've got another 5 that are under fit out, so we will end up between 12 to 14 department stores this year. We will do a similar number next year. And on beauty, we would do between 10 to 15 doors again. All of these would be entirely through internal accruals.
Okay. And capex would be around similar, around 120 to 130 crores kind of per annum?
Including refurbishments, yes.
Including refurbishments. Okay. Thank you. Thanks for that understanding, and all the best for that.
Thank you.
Thank you. The next question is from the line of Rahil Shah, an individual investor. Please go ahead.
Hello, sir. Just your guidance overall for the EBITDA and revenue margins outlook for the last quarter this year, for quarter 4 and financial year 24. If you have any target in mind, and which area of business are you expecting the most growth in?
The EBITDA, if you're asking for next year, it will be higher than this year in terms of overall margin. But if you're aware, we don't give any specific guidance on any of the margins. But all I can tell you is that it will be higher than this year, Rahil.
Okay. And where are you seeing the most growth from? I know you mentioned your beauty segment is doing well, the distribution channel. Any other business segment you're thinking to enter in?
Our growth will come from our strategic pillars. We are a house of brands, and that's the foundation on which our business is. And the disproportionate growth would come through beauty, private brands, and through expansion of our physical stores as well as online. The distribution business on beauty would support the growth within beauty.
Okay. And as for revenue margins, also you would say within the same lines as current growth for the next year?
Yes.
Okay. Okay, that's it from me. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Ankit Kedia from Phillip Capital. Please go ahead.
So my first question is regarding the private label. We will be touching around 100 crore revenue from private label this year. Out of the brands we have, how many brands have crossed 150 crores? And Stop would have multiple categories where they are present across. So if you can give subcategory-wise Stop, if any of them have become sizable in nature today for us, and what is the growth plan for these brands to grow further?
I wouldn't want to break down the individual brand numbers because obviously that's more internal. But what I would say is that of the 9 brands that we have, 2 of them would be 100 crores plus individually, and then the other 3 would cross the 100 crore in the next 12 to 18 months.
And so given that the discounting this time in private label would have been slightly higher, the EOSS was much earlier for the industry. Are we seeing gross margins under pressure lately, and are we comfortable with the inventory in the system we have for private label?
So firstly, the end of season sale for us actually was slightly later than earlier in the previous years. And so to that extent, the overall level of discounting that we have had to do was in line with what we had expected.
Sure. And the last question is, regarding the beauty business. ssbeauty.in is already launched. We can see the beta version live. We also seen the app, what you mentioned there. So what is the marketing plan, regarding this launch? Are we expected to spend higher in A&P in coming quarters? And also on the 500 crore B2B run rate, some part of this will also be in our Shopper Stop, right? And some part of the revenue would also booked in the standalone entity. So if you can just say how much are we looking from our own entity in Shopper Stop departmental stores vis-a-vis third party?
So on the ssbeauty.in, we plan to launch it formally in March, and it would be accompanied with a strong marketing program where we would give it, focus and bring attention of customers to this new platform. Obviously, it takes time to build acquire customers onto a new platform, and hence the investment that is needed for it. And it will be for both the ssbeauty.in website, the app, as well as for the SS Beauty stores, because what we are creating is a whole ecosystem for beauty as SS Beauty. In terms of the revenue that comes in through that, it is incremental to the extent that these are new stores and would be over and above what we get through Shopper Stop or through the department stores where we have the beauty brands.
Sure. So my question was from the B2B business, the 500 crores which you mentioned. So the business of that, some part, a big chunk could also be through Shopper Stop. So is that number over and above the 500 crores?
No, that would be included within that. And that would be within Shopper Stop. As Karuna had clarified, the distribution business itself would be under a separate subsidiary called Global SS Beauty, and the revenue from that distribution business will be under that vertical.
Ankit, just to clarify, whatever Shopper Stop sells to the end customers, it will be included in Shopper Stop sales. Whatever global sells it to Shoppers Stop and other companies will be in global SS Beauty company. On consolidation, the intercompany sales will be eliminated.
Sure. And Kavina, the investments which we have done in the subsidiary through CCPS, do you think the working capital requirement is sufficient currently for that? Or do you think as the size increases to 300 crores over next 2 years, we need to invest further in the subsidiary?
Ankit, I already answered the question. We have already invested 5 crores. We are planning to invest another 25 crores in this month. In addition to that, we will have some temporary borrowings to take care of the working capital. Net, we expect 50 crores in the next 4 to 5 months. What we have also informed the board is, as we increase the business and if there is a need for capital, it will be a combination of preference shares plus bank borrowings.
That's helpful, Kavina. Thank you so much.
Thank you. The next question is from the line of Varun Singh from ICICI Securities. Please go ahead. Mr. Varun Singh, please go ahead with your question. Your line is unmuted.
Yeah, am I audible now?
Yes, please go ahead, sir.
Okay, yeah. So thanks for the opportunity. So my question is on the beauty, B2B beauty business. Sir, so I just wanted to understand that what is the need of entering into this business, given that we already have enough on our plate with regards to revising the private brands and chasing high growth opportunity in small tier cities led by the success of incremental efforts that we are putting in revising the private label brands. So how are you thinking with regards to why to chase growth opportunity in the B2B space?
I think what I would like to emphasize is that the reason for getting into the distribution business is to strengthen our beauty pillar. Beauty, as you would appreciate, is an important strategic pillar for us, and to make the supply strong in that area is why we are getting into this. As most of, or the majority of what we sell in our beauty business is international brands and the big national brands that we have. And by having exclusive partnerships, we are able to bring in brands which are, we have the right of first refusal onto them. And depending on the strength of the brand and how we would like to take it forward, it gives us the ability to be able to take it much deeper within our own stores across both Shoppers Stop and department. The key factor, of course, which I would like to add is that it gives us the ability to get higher margins and better inventory control because of the fact that we have the end-to-end margin available with us.
Okay, so are we saying that the operating business economics of this segment of business will be superior or at least in line with the existing beauty business that we exist with?
Absolutely.
Understanding correct?
Yes, absolutely.
Okay, right. And sir, my second question is on the offline business. Sir, so we have been, I think, on strategy front, we have done almost all right things with regards to accelerating store renovation rate and optimizing store sizes, etc. But still, walk-ins numbers does not look very much encouraging. So, how are you looking at this number or gradual improvement? And also, the reason that I'm asking this question is because when we look at revenue growth from 3-year CAGR perspective, so it still continues to be a low single-digit number. So, when or how are you looking at improvement in this number? And of course, I think the current quarter number is, I understand, is very much encouraging. But any thoughts on this that will be really helpful?
It's an interesting point, and over a period of time, and what we focus on is looking at the total engagement that we have with our customers across offline and online. As you would appreciate, majority of the customer journeys start digitally today and eventually end up with an actual purchase. The fact that we have seen consistent increase in our average basket size is indicative of the fact that customers who are walking into our stores are the most serious customers, and that's what's helping us to generate the growth that we have. Having said that, coming specifically to customer entry, where we have now got into the drop which we used to see 4-5 years back has been arrested, and that is something which we are pleased about. What we are seeing is that customers are now coming in small. Earlier you used to see large groups of customers coming in, and that's changed, and that's the change that we are seeing across the country, where you've got smaller individual families coming in and individuals coming in, and that's partly why you don't see the total number not being high. At the same time, when we look at the specific stores which are our large stores, the customer numbers are growing and very encouraging. We have a few large small stores in catchments which have now become less dominant. While these are still large stores, it is into these specific stores where we see a drop in sales, and that could be one of the reasons for that is because we have expanded within that city itself.
Got it, sir. Got it. So that's very much helpful. Thank you very, very much.
Thank you. The next question is from the line of Devanshu Bansal from Emkay Global. Please go ahead.
Yes, sir. Hi. Thanks for the opportunity. Sir, there are multiple tailwinds for Q4 this year in the form of delayed winters, higher number of weddings, as well as no Omicron-led disruption as well. Can you help us understand how this Q4 can be different versus the historical Q4s based on the trends that you have seen so far in January?
We expect the Q4 numbers to continue the momentum that we've had in the first 3 quarters, and should be significant in March because of the comparison versus last year where there was a level of Omicron, etc. And so to that extent, it might not be directly comparable. But if we just look at the momentum that we have had and the absolute numbers that we have been getting in Q1, Q2, Q3, we expect that to continue.
Got it, sir. Typically versus historical trends in Q4 versus Q3. So how has that been shaping up so far in January? Are we seeing better results, or is it largely in line?
It's large. I would say it's slightly better than what we had expected so far.
Got it. And so comparable, the second question is on margin. So if we exclude the other income in both the quarters, it's 50 basis points decline. So what explains that?
We could not hear you properly. Can you please repeat the question again? You said some decline in margins.
Yeah. So, X of other income in both this quarter as well as base quarter, there is a 50 basis points of decline. So, what explains that?
This is last year you're talking about?
Yeah, versus last year Q3.
So, last year Q3 we had significant concession on rent, and overall the expenses were lower. But as we see, it's more or less in line with the numbers. I could not see a drop in margins.
Where are you picking this up from? Because we've actually had an increase in the margin.
So I'm talking about the pre-Ind AS numbers. So if we exclude other income from both the quarters, then we are getting a 50 basis points sort of a decline.
Okay, now we got it. See, that's I think Venu said in his speech. Last year we had significant concessions on the lease rental because it was impacted by COVID. What also happened last year was some of the concessions for Q1 and Q2 came in Q3, and we don't account unless until those concession happens. We accounted that. So that's one of the main reasons. Plus, we have also opened close to 9 stores this year. The productivity will improve as we progress. So, but some of the cost will be there. So these are the two large reasons where the EBITDA margin is 50 basis points lower than the last year.
Got it. So I was coming from that one. So this store expansion is going to continue going ahead as well. So will this sort of materially impact our margin improvement going ahead, or we should be able to sort of negate this impact with the kind of investments we are doing on private labels as well as on the beauty front?
We would be able to negate the impact of the higher lease cost with the growth in business that we would see across each of our strategic pillars.
Got it, sir. Thank you. That's it from my end.
Thank you. The next question is from the line of Vignesh Iyer from Sequent Investments. Please go ahead.
Hello. Yeah, I just wanted to know what is the ASP for the company in quarter 2? What is the number?
Our average selling price for the quarter was 1627.
Okay.
And that was a 10% growth over last year.